February 2026. Amazon announces $200 billion in AI infrastructure spending for the year. Microsoft, $100 billion minimum. Meta, $115 to $135 billion. Alphabet, $175 to $185 billion. Combined, $650 billion in 12 months. That's 60% more than they spent in 2025, which was 63% more than 2024. Microsoft's AI revenue run rate, approximately $25 billion annually. Amazon AWS AI revenue, estimated $10 to $12 billion. Google Cloud AI contribution, unclear, embedded in 32% growth. Meta's direct AI revenue, $0 reported. Do the math. $650 billion spent. Maybe $50 billion in direct AI revenue across all four. The depreciation expense alone on these assets exceeds the revenue they're generating. I started pulling the earnings transcripts in early February, not because I'm bearish on AI, because I needed to understand what was actually being built and who was paying for it. What I found isn't speculation, it's accounting, and it looks familiar. If that sounds useful, stay. Hit subscribe, and if this helps, give it a like. These aren't small numbers misaligned by a quarter or two. This is structural. In 2024, the 5 major hyperscalers, Amazon, Microsoft, Alphabet, Meta, Oracle, spent $256 billion on capital expenditures. In 2025, $443 billion. That's a 73% increase year over year. For 2026, analysts project $602 to $650 billion, depending on whether you include capital leases. Roughly 75% of this spending is AI specific. Data centers designed for GPU clusters. NVIDIA H100s and B200s. Custom chips, Google's TPUs, Amazon's Trainium. Power infrastructure. Cooling systems. The physical layer required to train and run large language models at scale. The remaining 25%, traditional cloud infrastructure, still generates the majority of their revenue. Here's what changed. In October 2025, Microsoft CFO Amy Hood said on an earnings call that capital expenditure growth would accelerate in fiscal 2026. This was a reversal. They had previously guided that growth would slow. The stock dropped 3% that day. Meta narrowed its 2025 guidance to $70 to $72 billion, then said 2026 would be notably larger. The stock fell 11% in a single session, the steepest drop in 3 years. Not because Meta posted bad results. They beat across the board. Investors understood what the spending meant. No clear revenue story attached to the expense. Amazon raised its 2026 guidance to $200 billion on its earnings call in February. The stock dropped 6% the next day, despite beating revenue estimates. This is what it looks like when the market starts asking, when does the infrastructure pay for itself? November 2022. OpenAI releases ChatGPT. Within 2 months, 100 million users. Fastest consumer product adoption in history. Microsoft had already invested $10 billion in OpenAI through 2023. In October 2025, they extended their commitment, $250 billion in Azure compute capacity through 2032. OpenAI now represents 45% of Microsoft's $625 billion commercial backlog. Amazon signed a $38 billion 7-year deal with OpenAI in November 2025. First major partnership between AWS and the ChatGPT maker. Alphabet inked deals with both OpenAI and Anthropic. The Anthropic deal alone, over 1 gigawatt of AI compute capacity by 2026. That's access to approximately 1 million of Google's tensor processing units. These aren't partnerships. These are infrastructure commitments. Multi-year contracts locking in hundreds of billions in spending before the revenue model is proven. The pressure is positional. In October 2025, Alphabet CFO Ruth Porat said during an earnings call, "We see significant opportunities ahead." Translation: if we don't build, someone else will and we lose the platform. Meta doesn't have a cloud service. They're building AI infrastructure to improve ad targeting, which already works, and to position for superintelligence, a term CFO Susan Li used on their Q3 2025 call. When asked about capital allocation and future buybacks, she said the highest order priority is investing our resources to position ourselves as a leader in AI. Not monetization. Positioning. By February 2026, free cash flow projections for these companies had shifted materially. See, Alphabet's free cash flow, estimated to drop nearly 90% in 2026, from $73 billion in 2025 to around $8 billion. Amazon projected to go negative by $17 to $28 billion, according to Morgan Stanley and Bank of America. Meta, free cash flow estimated to fall almost 90%. Microsoft, growing slower in capex than peers, still faces a projected 28% decline in free cash flow for fiscal 2026. This is the trade: spend now, generate cash later. Maybe. 1996. The Telecommunications Act passes. Deregulation opens long-distance markets. Companies like WorldCom, Global Crossing, Quest, Level 3 race to build fiber optic networks across continents and oceans. The promise? Internet traffic is doubling every 100 days. That was WorldCom CEO Bernie Ebbers' claim in 1996 to 97. It wasn't true. Traffic was doubling annually, not every 100 days, but the narrative fueled investment. Between 1996 and 2001, telecom companies invested over $500 billion, mostly financed with debt, into fiber optic cable, switches, and wireless networks. They laid 80 to 90 million miles of fiber. By 2001, 95% of that fiber was dark, unused. The demand didn't materialize fast enough to justify the build-out. Global Crossing went public in 1997. By 1999, its market cap hit $47 billion. In Q4 2001, the company lost $3.4 billion on $793 million in revenue. In early 2002, bankruptcy. One of the largest at the time. Equity holders wiped out. WorldCom followed. $30 billion in debt. Accounting fraud to inflate revenues. Bankruptcy in 2002, the largest in US history at that point. Between 2000 and 2002, global telecom stocks lost more than $2 trillion in market value. 24 telecom companies filed for bankruptcy in 2001 to 2002 alone. Bandwidth prices plummeted 90% as supply overwhelmed demand. The infrastructure didn't disappear, it got repurposed. The fiber laid by Global Crossing and others eventually became the backbone of the modern internet. YouTube launched in 2005, leveraging cheap bandwidth from the telecom overbuild. By 2023, YouTube generated $31 billion in revenue for Alphabet. The people who built it lost everything. The people who used it later made fortunes. Here's the difference between 2026 and 2001. Debt. In 2001, telecom companies were leveraged. WorldCom had $30 billion in debt. Global Crossing, $12.4 billion. When revenue didn't meet projections, they couldn't service the debt. Bankruptcy was structural, not optional. In 2026, the hyperscalers are in net cash positions. Amazon, Alphabet, Meta, Microsoft, Nvidia all carry more cash than debt. Oracle is the only major AI player with material net debt. This changes the failure mode. A revenue miss doesn't trigger insolvency. It triggers margin compression and free cash flow pressure. Painful for shareholders, not fatal for operations. But there's a second mechanic at play: depreciation. AI data center assets depreciate at roughly 20% per year. If the 5 hyperscalers add $2 trillion in AI-related assets to their balance sheets by 2030, current trajectory, that implies $400 billion in annual depreciation expense. In 2025, their combined profits were under $400 billion. The depreciation burden alone could consume all current earnings, before operating expenses, before R&D, before taxes. This only works if revenue scales faster than the expense, and right now the revenue is speculative. Microsoft is the closest to demonstrating AI revenue at scale. Azure grew 39% in Q1, fiscal 2026. AI contributed 16 percentage points to that growth. That implies an AI revenue run rate of roughly $25 billion annually, significant, but still a fraction of their $100+ billion CapEx commitment. Meta's Advantage Plus ad platform, powered by AI, hit a $60 billion annual run rate in Q3 2025. But that's existing ad business optimized by AI, not new revenue from AI products. Amazon, Google, Meta, all experiencing capacity constraints. Demand exceeds supply. Microsoft CFO Amy Hood said supply issues would continue into the first half of fiscal 2026. Sounds bullish. But capacity constraints mean they can't monetize demand fast enough to cover the build-out. The question isn't whether AI generates value. The question is whether the value accrues to the infrastructure builders or to the applications running on top. After the telecom crash, who captured value? Not the infrastructure companies. WorldCom, Global Crossing, Quest, Level 3, bankrupt or severely impaired. Equipment suppliers like Nortel, Lucent, Cisco, massive declines. Cisco stock peaked in March 2000, fell 86% by October 2002. Who won the application layer? Google launched in 1998, went public in 2004, built on cheap bandwidth created by the telecom overbuild. Amazon Web Services launched in 2006. Leveraged underutilized data center capacity. Netflix transitioned to streaming in 2007. Used cheap fiber to distribute video at scale. YouTube, Facebook, Twitter, all launched between 2004 and 2006. All benefited from infrastructure built by companies that no longer existed. The infrastructure didn't create the value. It enabled the value. The builders went bankrupt. The users became trillion-dollar companies. The parallel: OpenAI raised money at a $157 billion valuation in late 2025. Anthropic raised at a multi-billion-dollar valuation. xAI, founded by Elon Musk, raised billions. None of them are building the data centers. They're using the data centers built by Microsoft, Amazon, Google. Microsoft committed $250 billion to OpenAI. OpenAI's revenue in 2024, approximately $10 billion. To justify that commitment, OpenAI would need to reach $577 billion in revenue by 2029, roughly the size of Google's projected 2029 revenue. The infrastructure builders are taking all the capital risk. The application builders are capturing the revenue upside. You're not behind for not understanding this. The companies building it don't fully understand the return profile either. That's why Meta calls it positioning instead of monetization. That's why Microsoft stock drops when they increase spending, even as Azure grows 39%. The market is asking, when does this pay back? Here's what we know structurally. The spending is accelerating. $256 billion in 2024, $443 billion in 2025, $650 billion in 2026. Free cash flow is collapsing across the sector. Depreciation expense is rising faster than revenue. The companies building this infrastructure have strong balance sheets. They won't collapse like the telecoms did. But that doesn't mean shareholders win. It means the companies survive long enough to find out whether they built the right thing. If history holds, the infrastructure will be valuable. Just not necessarily to the people who built it. The applications that matter haven't been invented yet. Someone will launch the equivalent of YouTube or Netflix for AI, something that uses all this compute capacity in a way that generates billions in revenue. It probably won't be the hyperscalers. It will be a company that doesn't exist yet, leveraging infrastructure built by companies spending $650 billion this year to make sure they don't get left behind. I'll keep reading the filings. I'll keep tracking the depreciation schedules, the free cash flow projections, the capacity constraints. Not because I know what happens next, because the math is public and the pattern is visible, and understanding how capital flows through systems like this matters more than guessing whether AI is a bubble. You weren't wrong to feel uncertain about where the spending leads. The companies spending the money are uncertain too. They're building, because not building means losing position. That's not a strategy. It's a structural inevitability in winner-take-most markets. The infrastructure will get used. The question is who profits from it. If that's useful, subscribe. I'll keep documenting what I find.